You spot what looks like a rock-solid trend forming. You wait for the right moment, you execute your buy order, and almost immediately, the market reverses course. It feels like the market is watching your terminal, setting traps to keep you chasing shadows. It is the universal frustration of the forex trader. But there is no trap. The root cause of this failure usually comes down to the tools on your screen, specifically a reliance on standard, widely used indicators like the Relative Strength Index, or RSI. These standard tools share a structural flaw that guarantees you will be late to the party. They are built entirely on simple averages. Look at this line chart. When a volatile price spikes upward, any line calculated by an average mechanically drags behind the current price action. It cannot catch the peak in real time. By definition, an average requires historical data to exist. It is a reflection of the past, not a predictor of the future. Traditional indicators do not show you where the market is going. They show you an echo of where it has been, ensuring you are reacting to outdated information, one step behind the rest of the herd. Mathematician John Ehlers approached this problem from a different angle. His background was not in traditional finance, it was in electrical engineering. To an electrical engineer, a chaotic price chart functions exactly like a raw radio frequency. Within that transmission is a clean signal trying to get through, but it's buried inside erratic static, market noise. Ehlers' solution to this was the cycle. It is a technical indicator that uses digital signal processing, the same math used to tune a radio dial, to isolate that clean wave. Ehlers applied a unique series of smoothing formulas that identify the cyclical nature of currency pairs, significantly reducing the lag found in traditional oscillators. The cycle addresses the problem of the echo. By stripping out the market's static, you can read the underlying rhythm of the price action with much higher responsiveness. On your screen, the cycle breathes back and forth, oscillating across a central zero line as the market cycles up and down. To use it mechanically, you watch two components, the main indicator line itself and a secondary tracking line called the trigger. Take a look at this close-up. A major entry signal occurs when the cycle line crosses above the trigger line. That upward cross suggests building bullish momentum. The opposing signal happens when the main line crosses back below. This downward cross suggests the current price cycle is peaking and a downward move is likely. Because these trigger crosses happen without the standard lag of a simple average, you see a price move exhausting itself in real time. This allows for earlier entries and tighter stop-loss levels. There is, however, a catch. The cycle's primary strength, its high speed, can also make it difficult to manage. In a choppy or sideways market, where the price is bouncing in a tight range, the sensitive math can generate several signals in a very short period. Following every cross the indicator generates in this environment often leads to overtrading and unnecessary losses. Professional traders account for this speed by rarely using the cycle in isolation. This layout shows a common pairing. We use the fast cycle on the bottom alongside a slow-moving traditional trend indicator up top, like a long-term moving average. You only take the cycle's buy signals when the broader moving average is pointing upward. This hybrid approach helps filter out the false positives by combining the stability of the macro trend with the timing of the microcycle. Once you understand the basics, you can look for a more advanced analytical setup, detecting divergence. Watch what happens when the price of a currency pair pushes up to form a new high that is higher than the previous peak. Notice the discrepancy. The price is higher, but the cycle makes a lower high. This divergence indicates the underlying frequency is dropping. It is a technical warning that the current trend is losing steam, even if the price candles suggest otherwise. When you see this, you can tighten your stop-loss levels or take profits before a potential reversal hits. It's an important reminder that the forex market does not move in straight lines. It moves in rhythmic waves. Using tools designed for linear measurement often leaves you reacting to the past. By upgrading your toolkit to focus on signal frequencies rather than lagging averages, you stop relying on reactive guesswork. While it takes practice to read these rhythms, it offers a technical framework for observing the market with much greater clarity.